welcome back to the deep dive. Okay, today we're really zoning in. We're doing a high-velocity briefing, focusing squarely on the strategic direction of, well, a massive financial powerhouse.
That's right.
Our source. It's the Q3 2025 earnings call from Goldman Sachs. But here's the twist. We've laser-focused this dive just on the opening remarks, the foundational stuff from Chairman and CEO David Solomon.
Exactly. Our mission here, for you, is all about precision. We're cutting through all the extra noise. We want to pull out that core strategic vision, the key performance indicators, and the forward-looking plans straight from the top.
So a shortcut to understanding where Goldman Sachs is heading, basically as of October 14th, 2025.
You got it. A direct line.
And right out of the gate, the tone was, well, unmistakably strong. Solomon kicked things off announcing very strong results for Q3.
Yeah, he did.
And they reflect the strength, the dominance, really, of their market-leading franchises. But, okay, before strategy, we need the numbers he led with. Got to ground this.
Absolutely. And if you look at the core metrics he shared, they definitely backed up that strong framing. Net revenues hit $15.2 billion.
Yeah.
Earnings per share, EPS, that came in at $12.25.
Right.
And crucially, return on equity, ROE, that was 14.2% for the quarter. But what's kind of fascinating is the immediate precision he brought to the year-to-date figure.
Oh, yeah. What happened there?
Well, he initially said 14.6% for the year-to-date ROE, but then pretty quickly he corrected himself upwards to 15.6%.
Okay. A 1% difference year-to-date. I mean, it sounds small, maybe, given the scale we're talking about. But is it? What does that little correction tell us? Maybe about the complexity of pulling all these numbers together.
Well, I think it signals a relentless focus, that 1% difference. We're talking hundreds of millions in return.
Oh, okay.
And hitting 15.6% year-to-date keeps them right where they want to be, in line with their long-term targets.
Right.
So on a call that's all about long-term strategy, yeah, that kind of precision matters. It shows they're managing right down to the basis point.
Precision. Got it. But then there's dominance. The CEO spent quite a bit of time on what he called the increased momentum in their #1 investment banking franchise, M&A specifically.
Yeah, he wasn't shy about that. He kept underscoring their dominant position.
And dominant really seems like the right word when you see the scale, right?
It really is. I mean, look at the milestone they hit. Advising on over $1 trillion in announced M&A deals for 2025, just year to date.
$1 trillion. That's just huge.
It's colossal, but that headline number isn't really the strategic point. The real takeaway is the competitive moat they're building.
Okay, so what does that moat look like in, hard numbers?
Well, that $1 trillion volume, it puts them $220 billion ahead of their closest competitor.
Wow. $220 billion gap.
Exactly. You don't get that kind of lead through luck. That's structural advantage. It means they're consistently winning the biggest, the most complex, the most important deals around the world.
Right. They're playing in a different league.
Pretty much. Only a handful of firms can even compete at that level.
And he gave examples to, really show that leadership. I remember the Electronic Arts one, that a massive $55 billion sale. Goldman was the exclusive advisor.
That's the one. To that consortium, PIF, Silver Lake, Affinity Partners.
Right.
And then there was the Baker Hughes deal, $14 billion acquisition of Chart Industries. Goldman was lead advisor there, too.
Okay.
And they advised and provided financing for Thoma Bravo's $12 billion LBO of Dayforce. So you see market-shaping deals across tech, energy, private equity.
Right. These aren't just one-off advisory jobs. This plugs right into their whole philosophy, doesn't it? The one Goldman Sachs idea.
Exactly. The CEO really emphasized how this M&A dominance creates this powerful multiplier effect.
Okay, break that down. How does the multiplier work in practice?
Sure. So you start with the initial M&A advisory relationship, right? That big deal fee. But that's just the start.
Okay.
The one Goldman Sachs model means that single transaction then spins off other business across the entire firm. It generates revenue streams that competitors who only do advisory just can't capture.
So things like bridge financing, derivative hedging, maybe new investment ideas for their wealth management clients.
Precisely. All of that.
So the deal itself becomes a lead generator for the whole firm.
That's exactly it. Think about it. If you're handling a complex $55 billion tech sale, you're in the perfect spot to offer sophisticated hedging for currency or interest rate risks.
Makes sense.
And you see what financing needs might come up next, needs that maybe only you can meet. It's like a self-feeding ecosystem. It deepens the client relationship across divisions, makes them stickier.
Okay, that explains the strengths now. But what about looking ahead? The playbook. Solomon talked about more than just dry powder. He mentioned a kind of behavioral shift among CEOs globally.
Yeah, that was interesting. He noted that CEOs, after navigating a few really volatile years, inflation, supply chains, rate hikes, all that.
Right, a tough period.
They're finally shifting focus back to long-term strategic decisions. They've kind of adapted to how things are now.
So they're done just playing defense.
Seems like it. They're back on the offensive, looking at scale, M&A, investing for growth again.
That feels like a pretty critical signal. Suggest maybe more stability, more confidence in the C-suite to take big swings again?
Absolutely critical.
So what are the specific, measurable tailwinds they see pushing M&A forward?
Okay, first big one, the sponsors. Private equity sponsor activity is tracking 40% higher year over year.
40%? Wow.
And here's the metric that should really stick with you. Sponsors are sitting on over $1 trillion of dry powder.
$1 trillion just waiting.
Committed capital unspent. And they manage something like $4 trillion in private equity assets overall in their portfolios. That is a massive amount of money that needs to be put to work.
And I guess macro factors help too.
Yep. The expected rate cuts here in the U.S. are providing what he called a constructive setup.
Meaning?
Lower borrowing costs.
Yeah.
It just makes those huge leverage buyouts, like the Dayforce one they worked on, more attractive, easier to pull off.
Right.
So you combine that patient capital, the prospect of lower rates, and this renewed optimism from corporates. It paints a powerful picture for future deal flow.
Okay, let's switch gears slightly. The market's business FIC. So fixed income, currencies, commodities, and equities. That also showed some impressive resilience, didn't it?
It did, rising year over year for the 7th straight quarter.
7 quarters. That's quite a streak.
It really speaks to the quality of those trading operations, that institutional strength. And that momentum. It helped drive a record year-to-date performance for equities and real strength in their rates business within FIC. It just proves that even if M&A has its cycles, their markets division is this reliable, resilient engine for global revenue.
But the CEO did temper that a bit, right? Added a note of caution, especially around the current market mood, AI in particular.
Yeah, he did. He acknowledged the investor exuberance we're seeing, U.S. equity markets hitting record highs.
Driven a lot by AI hype, or investment anyway.
Exactly. He said it's fueled by a tremendous amount of investment in AI infrastructure. But then he quoted the firm's prudent stance, stressed the need for disciplined risk management.
So don't get carried away.
Basically. He said they need to be especially vigilant in times like these. He's reminding everyone, look, we participate, but we also need to stay disciplined when valuations get this high.
Vigilance is key. But the growth engine, that's still running full throttle, especially in asset and wealth management, AWM. What were the big growth numbers there?
Yeah, it's a relentless growth there, all designed to deliver those more durable revenues he talked about. Assets under supervision, AUS, hit a record $3.5 trillion.
$3.5 trillion. Okay.
And wealth client assets also hit a record, $1.8 trillion. And he specifically called out record results in fees and lending, those stable annuity-like revenues they've been focused on building.
But the number that really jumped out, at least to me, was in alternatives fundraising. That seemed like a huge revision upwards.
It was startling, yeah. They raised a record $33 billion in alternatives just in Q3.
$33 billion in 1 quarter?
Right. And based on that momentum, they revised their whole full-year expectation. They now expect to raise around $100 billion in alternatives this year.
Wow, that's a huge jump from previous expectations, presumably.
Substantial. It's driven by really strong, consistent client demand for things like private equity and private credit strategies. They basically just added the equivalent of a whole mid-sized asset manager to their forecast in 1 quarter.
That kind of growth that often comes with partnerships, right? Acquisitions. Did he mention anything there?
He did. Detailed 2 key moves. First, an acquisition. Industry Ventures.
Okay, what do they do?
They're a leading venture capital platform. Very strategic fit, apparently. Complements Goldman's existing secondaries investing business.
Oh, okay.
Brings this attractive tech investment capability into what they call the External Investing Group, XIG, which already manages over $450 billion in AUS.
And the idea is?
The expectation is that Industry Ventures' deep relationships, especially in tech, will drive new opportunities. Feed the investment banking pipeline. Maybe offer new stuff to wealth management clients hungry for tech growth.
Makes sense. And the second move? A collaboration.
Yeah, a collaboration with T. Rowe Price. This one seems aimed more squarely at, the mass affluent market.
Oh, so?
It's about accessibility. The goal is to deliver a range of solutions, public markets, private markets, but tailored for retirement and wealth investors. They're trying to, as he put it, bridge the gap
Bridge the gap
between those complex, maybe higher growth private market opportunities and what individual investors typically have access to. Basically, letting more people tap into their 30 years of private markets experience.
Interesting. Okay, now let's talk about maybe the biggest headline from his remarks. Turning that growth engine inward. The launch of One Goldman Sachs 3.0 propelled by AI.
Right.
This sounds like more than just, an internal tech update.
Yeah.
He framed it as a whole new operating model.
Yeah.
Centralized.
Yeah, this feels like the strategic climax of his presentation. It's a massive multi-year effort, centralized, as you said, and designed not just to cut costs, though efficiency is key, but really to create capacity for future growth.
So they're replumbing the whole place while things are actually going really well?
Exactly. They're not waiting for a slowdown. They're doing it while operating at these record highs.
And they've got specific goals for this. He mentioned metrics.
Yeah, 6 quite comprehensive stated goals. It really covers the whole spectrum of the business.
Like what?
Enhancing client experience, improving profitability, driving productivity and efficiency, strengthening resilience so they can scale better, enriching the employee experience, and, crucially, bolstering risk management.
Wow, okay. That's ambitious. It's not just about, automating a few tasks.
No, definitely not just about reducing headcount or something simple. It's about using AI to fundamentally re-engineer core processes so the whole firm can operate at a higher level, a more sophisticated scale.
6 goals for one giant AI transformation. Where are they starting? Where's the initial focus for this AI reengineering?
But they're targeting what they call front-to-back work streams, things that get an immediate benefit from AI-driven process reengineering.
Okay, practical examples.
Think about sales enablement, client onboarding stuff that directly touches clients, but also critical internal functions, lending processes, regulatory reporting, even vendor management.
So really across the board, front office, back office.
Exactly. It shows this holistic commitment to automating internally, boosting efficiency from that first client interaction right through to the final regulatory filing.
So wrapping this up, what's the big picture takeaway? The CEO sounded incredibly confident, talked about the foundation they've laid, the dominant franchises, the talent.
Yeah, the overarching message seems really clear. Sustained success isn't just about reacting to change, it's about anticipating it. And this launch of 1GS 3.0, this AI-powered operating model, it feels like the ultimate expression of that long-term discipline. They're using AI to transform their internal engine during a time of market enthusiasm and peak performance, strategically setting themselves up for the next decade.
Which does raise a really interesting question, maybe for you, the listener, to chew on. We're in this moment of, as the CEO put it, AI exuberance.
Right.
So how might this massive internal AI-driven transformation at a place like Goldman Sachs, a move focused on creating capacity and efficiency, how might that redefine what market leadership even means in the next cycle? Feels like a huge proactive bet.
A bet that efficiency and resilience, supercharged by AI, are maybe the ultimate differentiators going forward.
Yeah, it'll be fascinating to watch.
And if you want to track that bet, the CEO promised more details, said they'll provide an update with more metrics on this AI operating model on their next call in January. So stay tuned as this whole transformation unfolds.